Welcome, everyone. My name is Lorraine Gilbert, CEO of WealthWise Financial. I've got with me here John Milligan, our Director of Investment Strategies, and we are excited to present to you our mid-year outlook. It has been a phenomenal first half of the year in the markets, and I'm sure on everybody's mind is now what? And as we always do in this presentation, we look back to say, what did we say the last time we did a presentation like this, which would have been end of year? What did we say about going forward? So we're going to look back at that, and then we're going to give you updates on what we've been up to on your behalf, and then also, looking forward what we see as well. So with that, I'm going to turn it over to John Milligan, who's going to present to us. Thank you, John.
Perfect. Thank you very much. Let me just make sure I'm on the right spot here for sharing. I am. Okay, great. So I'm just going to go back here and share my screen and start broadcast and then scoot it on over. Okay, let's do that. All right. Does everyone see that?
Yes.
All right. So I'm going to be making some little annotations and notes on this presentation. So that's why I've got it in the PDF formats. And we are recording this, so you can go back and watch it at a later time. We'll be sharing that. We'll be sharing it in our weekly market commentary, a link to this. So we'll probably have it out in the next one or maybe the one after that. And if you've been keeping up with our weekly market commentary, which we author in-house, a lot of this stuff is going to sound familiar. We've had several different investment themes that we've been writing about, that we've been thinking about. And so this conversation here is really going to bring in a lot of that. And then also another little note about today's presentation. To make it easier to get it through compliance, get it out to you, we're going to refrain from mentioning a lot of individual stock or company names. Any that are mentioned are going to be for educational purposes. So if you see me kind of, avoiding mentioning a specific name, it's for that reason. So like Lorraine had mentioned, we're going to start. This is a copy paste of a slide from our end of 2025 conclusion. And so we had a few bullet points here, and we'll go through each of these. But the first thing is that what we're going to do this year, we were going to decrease our exposure to multiple contractions. And so when you look at stocks, you can look at how they're priced. And the way that they're most often quoted in terms of their pricing is the price of the stock relative to how much that company earns. It's called the PE ratio. And so a high PE ratio means that there's a lot of expectations for the stock. And if the price comes down, that's called a multiple contraction. So if the earnings stay the same while the price comes down, it's called a multiple contraction. And so that's one way you can see your stocks go down, is that the enthusiasm wanes. Even though the company's making the same amount of money, the multiple contracts, the stock price goes down. So we look to start to decrease our exposure to multiple contractions from places, but we still wanted to maintain exposure to data center build out because that tailwind is still strong. So how are we going to achieve that? Well, it's through increasing exposure to places where there was not high multiples. So that includes small caps. At the time, financials, we refrained from expanding in the financials. We did buy a little bit more of one financial stock this year, not a lot. We just increased our position a little bit when its price was down, and it's recovered and come back a bit more. But we still like the prospect of financials. And then lastly was certain alternatives. We've been reviewing these, but haven't really made a strong move into those yet. So mostly on the small cap side. We were pending further trade resolutions before increasing international exposure. We just saw more trade conflict with Canada this past week. Still, that's one area that's keeping us from going any kind of overweight on international. We got some other things we're going to talk about later in this presentation. We decreased our bond duration in late 2025. Interesting slide showing the timing of that later in this presentation. And we may decrease slightly more in coming months. That's one area that whenever we've been looking for cash or ways to trim down the accounts, we've been taking it from our bond duration. And then lastly, we're maintaining high quality bond exposure. That stays the same. We'll talk about that a little bit later. So activity year to date. In Q1, we trimmed some heavily appreciated large cap positions with high multiples. And so caveat to this, if you're in an account that's taxable, we're much more cautious there. So we're not just going through and selling everything that's been appreciated. If you've got capital gains considerations, we're much more measured in that area. But we've been going through looking for places with high multiples that we could trim. And we also early in the year got almost all of our software exposure out of our portfolios. And that has been something that's also worked out. We did some tax loss harvesting at the beginning of the year. We did that in really the only two places we could. There's only really two places in our portfolios where we had any chance to even do so. And one was in the healthcare space, and the other one was in some bond areas. We got some bonds that were paying 4 or 5% in interest and coupons, and that was giving us a positive total return. But the bonds had a little bit of depreciated in price, so that gave us the opportunity to tax loss harvest them. So we still got a positive total return on the bonds, but we're able to tax loss harvest on those. We added a substantial position in a diversified basket of energy. We're going to talk more about that about midway through the presentation. Initially done to offset geopolitical risk tied to oil prices, but we'll talk a little bit more about the rationale of maintaining that position a little bit later. In March, we opened a new position. This is particularly for our growth investors. We've been looking at small companies. It's what we've spent a lot of time doing this year. We made for our growth-oriented investors a purchase in one small company, which has already risen 150% from its first batch of purchases. And then on the day the Russell 2000 closed at its lowest point, March 30th, if you could pull up Google Russell 2000 price and look at the chart, and you can find the lowest point. It's March 30th. That was the day we executed trades to buy a size position in mid-cap growth funds, and that fund since has outperformed the S&P 500. And then we've made additional growth investments in Q2. Again, refraining from making a lot of specific mentions into names of stocks in this presentation, but we've been looking for more growth opportunities in Q2. So now we're going to touch on index returns year to date, just to give you some context of what's been happening. Down here at the bottom, this is bonds. And, there's been a lot of questions about the Fed that we're going to talk about a little bit in this year. But, this is, again, kind of keeping bonds a bit muted on the total return side. In the high single digits, the EFA, which is Developed International and S&P 500, coming in right around 10% year to date. The technology index, as you can see with the, through the first quarter of the year, really started to get most impacted by that slide, and has since recovered pretty substantially, all the way up to 14% year to date. And then lastly, this orange, these are the small caps we mentioned, the small companies that really have had a lot more of that rotation trade. So as money has moved out of the some of the large cap names where we've seen the multiple contraction, the rotation has gone into small caps, and you're going to see that not this slide, but the next one.
John, before we move from that page, I'd like to make one comment here. This is a great slide that shows these different areas of the market, as John just went over, everything from fixed income to areas of the equity markets. And this is why, a couple of things, why a diversified portfolio is so important. And the other thing I want to point out is why equities themselves are so important, along with fixed income. The fixed income piece is a ballast. It can even out the volatility of our equity volatility. But at the end of the day, even in retirement, you need to have equity exposure. And then it's a question of how much equity exposure you have in retirement. And, that's a one-on-one discussion with each person. But I wanted to point that out. Very important to have both a diversified portfolio as well as have equity exposure.
Absolutely. Yeah. We've been writing about that in our commentaries too. Looking at empirical, results all the way back from the 90s. And so this is a slide we show pretty regularly, and it's actually a component of JP Morgan's Guide to the Markets, which is a great thing you can, look up and look at yourself. And they have all kinds of great bits of information that dive deep in the markets. This is one of my favorite slides they publish, and they always publish it. And it's essentially showing all those dots are actual returns. And so, like I mentioned, the PE ratio is like how expensive stocks are. High PE means expensive. And so on the left side here, this is the forward PE, which is on the horizontal axis, and then your subsequent returns on the vertical axis. And so on the left side here, these are the subsequent 1-year returns. And as you can see, no matter where your PE ratio is, it's kind of all over the place. There's no real correlation there in the 1-year time frame. And one of my favorite market economists, Eugene Fama, always says that within 1 year, stock prices are a random walk. They just, it's hard to predict where they go. But in the long term, over the long run, they will follow earnings and cash flow. On the right side here, though, as you can see on the 5-year return, wherever you buy stocks at a PE ratio, it tends to become more correlated, and so or negatively correlated. And so as you can see here, where we are right here in this red, we're in an okay zone, and this is for the S&P 500 in particular, for large companies. Subsequent 5-year returns, there's been observations where it's been nearly 20%. Annualized single digits is where high single digits where it's at right now. Only a few examples of it being negative. So, there was a point not too long ago where we're closer to up here, a little bit of a scarier place, but right now kind of in a more of a safe zone for valuations. And we'll see a little bit more about that here on this slide. This is from Ed Yardini and his group. They make lots of wonderful charts that we follow regularly. And so this is the PE ratio of 4 different cohorts. The pink, that's the Mag 7. Coined in the last decade. These are the big 7 names that have been driving the S&P 500. As you can see, especially after the pandemic, their valuations got extreme. They came down a lot all the way to 2022. They've still been elevated. And then year to date, like we mentioned, that the multiples have contracted. They've come down. When multiples contract, prices of stocks come down unless their earnings are going up. And then this is the S&P 500 in general. Again, multiple contraction. And then at the bottom, you see small and mid-sized companies. Those have been on a trend up. Historically, or not historically, but over the past 5-6 years, large caps have been more expensive than small caps. There's been more enthusiasm about the earnings growth of large caps versus small caps, and that's generally been the case over history. Large companies are been able to grow earnings as an aggregate. Smaller companies can grow faster, but as an aggregate, more flows to larger companies. And so now we're going to talk about earnings expectations. So the multiples have come down a bit on the large caps. So when multiples come down, that gives you less risk of multiple contraction. But you could have the possibility of earnings contracting. Well, Wall Street tends to set companies up for success. They like to put wide goalposts out here. These are the earnings expectations, and then the actual earnings growth for companies. And so as you can see here, that the expectations are in gray, and the actual is in dark blue. And as you can see, it typically is that the actual is higher. Wall Street likes to set companies up for success. What are we dealing with in this most recent quarter, where we just had the banks report? Now we're about to get into some technology names reporting. Very high expectations for earnings growth. And so if we follow the trend line, the actual would maybe be somewhere up here. And so this does spell well if they meet expectations, then and multiples stay low, this could be a tailwind for prices. Earnings go up, multiples stay the same or expand, prices go up. But also we have to be careful, because we don't want Wall Street to set up too big of a hurdle, because if for some reason it comes in down here, that scares the market and can cause a little bit more multiple contraction. But right now, we think we're set up in a spot to where it's relatively safe compared to other periods. So now we're going to talk a little bit about some economic things that we're watching. A big one is inflation. The reason why inflation is such a big part of the conversation is because of the Federal Reserve. Federal Reserve sets interest rates. The interest rates can affect everything. They can affect demand. They even can affect the pricing of bonds and stocks. Higher interest rates can have a depressing effect on the prices of stocks and bonds. We can get into the mechanics of that, but really all it's important to know is that that is the correlation, the effect. And so one of the things we've been writing about in our weekly market commentary is that we think the secular trend of inflation is on a downward trend. and that what has been driving inflation over the past several months has been a non-secular thing. It's been event-driven, non-secular. And so everyone who is baking in these expectations for the Fed to hike rates because inflation is suddenly popping its head up, you have to think a little bit more about what's the objective of the Fed, what can they actually do, et cetera. But the reasons why we think we're in a secular trend for inflation coming down is there's four noted areas from economists that can cause inflation to come down or even cause deflation. Only four areas. One is globalization. So globalization means more companies coming into markets and competing. When more companies come into markets compete, brings prices down. The next one is technology. So technology can bring the prices down to produce goods and services and deliver goods and services. The next one is money supply. So if money supply is not growing as fast as it normally does, that can be disinflationary. It can bring inflation down. And then the last one is weak aggregate demand. And so what have we been observing? One, China's manufacturing overcapacity. You can look this up. It's incredible. Their capacity utilization rate is the lowest it's been in almost 10 years, but they have a massive manufacturing supply. I am blown away by some of the things that I see coming out of China right now that is just so cheap. I mean, and it's actually, more well built than you'd expect. The cars coming out of China, people are pretty impressed by them. Last week, I was showing a coworker that at Home Depot, they're selling a $400 toilet from China that was, a full bidet, heated seat, all the bells and whistles from Toto for $400. So anyway, China's poised to just flood global markets with all kinds of cheap goods. Next is money supply growth. The Federal Reserve actually decreased money supply over the past couple of years, the most it's ever done in history, and we're still growing slower than we have on money supply. And then the last one is technological disruption. If AI does anything, it's going to bring down the cost of delivering goods and services. And so these are things that are going to be secular disinflationary, and the Fed has to be observing these things. So what has the Fed been observing recently? Well, what's been driving inflation is energy. So energy's been the thing that's been high. It's been pushing inflation up recently in recent months. And if we think about what the Fed can do to combat inflation, raise rates. Well, you raise rates, is that really going to have people stop using the pump? Putting your gasoline on a credit card or taking a loan out for it isn't necessarily the general function. Usually people are using interest rates to buy houses or other durable goods, which all are seeing consistent declines in pricing and inflation rates. But actually, if you raise rates, it can cause companies to invest less in infrastructure, which could actually be cyclical and cause inflation to go up.
Yeah, so let me just make a point right here. And that is that this is what's so important about digging below the headline, going beyond what you might see in a clip, in a headline about inflation. We look behind that to say, where is the inflation coming from? Because there are many different areas that it could be coming from. And here in this chart, you can see the driver, as John just said, has been energy. And so given that, we don't see that the Federal Reserve is going to be acting on a short-term movement of energy prices by making huge shifts in rate policy. So looking at that, we think that while we're not seeing interest rates go down very quickly from here, we're also not seeing rising rates either. And that has a lot of investment implications. John, I'll turn it back to you.
Thank you. So, and then this is going to be the last slide on inflation. But on the left here, and I wrote CBOE. It's actually CME. CME produces their Fed Watch and federal funds rate expectations. And so they have a way of looking at market pricing to produce a mechanism to basically extrapolate what the market expects interest rates to be going forward. And so 1 month ago was the orange line, and the market was projecting that around November, December, we're going to see one rate hike. And then with recent developments, they shifted it forward to basically the next meeting. So in the next meeting, they expect us to go from the current rate, which is about 3.625, and shoot up to 3.875 for the federal funds rate. But here's something I'll show you on the right. And one of the reasons why they made this adjustment was because of an adjustment to the federal funds rate forecast. And so we've seen an increase in the amount of members of the Federal Reserve suggesting that there's going to be another rate hike. So there's these dot plots, and they're members of the Federal Open Market Committee, and they kind of weigh independently. Each of them weigh their opinion, and then their opinion is plotted on a dot plot, as you can see right to the right here. And so what this is this the year-end forecast for the federal funds rate. And as you can see, where the current federal funds rate is right here, you have approximately half the members that are above that. And so that caused the market to say, hey, look, we got a decent amount of the FOMC members suggesting there's going to be at least one rate hike by the end of the year. But what we want to show you is these are the actual voting members, the people who actually vote on the interest rates. And the majority of them are still at the stay consistent or less. And so that is one thing that I think a lot of market participants are missing, is that it's really mostly the non-voting members that are suggesting that we should be hiking. And then so next, one of the things that we like to just bring up in these presentations is just general credit quality and the health of the economy. And one thing is that there's a lot of worry about the housing market. There's a lot of seeing a lot more ink spilled about the housing market and the quality of that. But again, we just want to highlight that mortgage originations are strong, especially by credit score. So looking back into the 2000s and this period, which is really not being replicated, which kind of drove the housing crisis and the subprime debt in the housing market, that hasn't been replicated. And in fact, since 2021, it's been some of the best mortgage originations by credit quality over the recorded history. And so this is a part of the market where we're not particularly concerned. One area that we have been watching is what we've been writing about a lot, and this is the bifurcation of the economy, how people with wealth are feeling wealthy and feeling more and more wealthy. And stock market all-time highs, they feel great, they're doing great. But the people who aren't wealthy, people who don't have wealth, the people who are in the bottom quartile of wage earners, they've been struggling, and we observe it in a few areas. Serious delinquencies and credit cards are near where they were in the great financial crisis. Student loan repayments has been atrocious, and so there are parts of the economy that continue to be weak. And we read the New York Fed's consumer credit reports whenever they're published, and it continues to be an issue for the economy. Is people on the lower end, which is one of the reasons why we've been avoiding certain sectors of the economy that are heavily exposed here. But we could find some good prices there in the near future too. So on this slide here, we're going to talk about sectors. And so these are the sectors, the S&P 500. And on the left here, you can see their year-to-date performance. This was as of late last week. And then over here, this is how we're allocated across each of our portfolios. Now, I'm going to throw a little caveat on here, and that it is kind of difficult to really capture where your exposure is. An example of that is Amazon. If we put Amazon in the portfolio, it's captured 100% as consumer cyclicals or consumer discretionary. But they get most of their profits from running data servers, AWS. And so that's more of like information technology. So from that perspective, they're more of a technology company. SpaceX is an industrial company, but a lot of their valuation is based off of XAI data centers, and they get most of the revenue right now from Starlink, which would, theoretically be communication services. And so it's really hard to throw all of your assets into an item that spits out your exposures, because companies aren't 100%. Microsoft gets most of their or Facebook gets most of the revenue from outside the US. They're a US based company, but they're more economically exposed to outside the US. So you have to kind of, take that context into consideration here when we look at things. But as you can see, um, you know, the areas that done best year to date: energy, industrials, and technology. We've been overweight industrials. We've been overweight energy. Technology is one area that it looks like we've been particularly underweight. The reason why it looks like this is because we got out of software. If you look within information technology, you've got hardware, semiconductors. We've got a lot of investment in semiconductors. The semiconductor index is up, almost 100% year to date. There's a lot of areas in information technology doing really well. And then you've got areas in the software space that are as bad as they've been in a decade. Absolutely getting destroyed year to date. And so that's one of the reasons why our technology exposure is looking so weak.
And John, what the software itself is down how much year to date?
I could pull up
just approximately, because that was an important move that we made by seeing what was happening in the software space, exiting that, and focusing our technology positions in different ways. So just like you said, it looks like we're underweight, really not. We just omitted software. We've been looking actually for opportunities, but it's been just a downward spiral in software. So we didn't want to have that exposure. At some point, we will again. But just was wondering if you have a number on approximately where that was.
Let me see if I can I'm trying to just get the S&P 500 software sector, by itself. It looks like by itself, the S&P 500 software sector is down about 10.5% year to date. Just the sector, the software component of the S&P 500, right, narrowing that down.
And so once again, another good move as far as, minimizing our exposure in that way.
Mm-hmm. Yeah, I think there's been a few companies that have been kind of pulled into that and been unjustly impacted with this software sell-off. but yeah, and there's reason to believe that maybe AI isn't the bringer of doom. That on software that everyone thought it might be. So I'm actually going to come back to this slide. And so we're going to talk a little bit about free cash flow. So we have an overweight energy. There's been the back and forth with the Strait of Hormuz and the issues in the Middle East. And energy is kind of a tough place to invest in, because it has that kind of speculative nature. Are oil prices going up or oil prices going down? Difficult place to invest. But what I want to show you here is this is a basket of 5 of the largest energy names, the S&P 500. And the blue column is the aggregate total operating free cash flow of those companies. And then the orange line is the price of Brent crude. And you can see the relationship. When the price of Brent crude is higher, they generate more free cash flow. When you study stocks, in the short run, like we mentioned, the prices are pretty random. Headline risk, people moving money here and there. But over the long run, the strongest correlation of stock prices is the earnings growth for the company. And even better than earnings growth is the free cash flow growth, because earnings can be kind of manipulated a little bit by non-cash items like depreciation and things like that. Free cash flow, if you track the free cash flow, if you have an understanding of what the free cash flow growth is going to be for a company over the long run, you're going to have a general idea what the stock price appreciation is going to be. And so if you've seen like the movie Moneyball, which is a movie about baseball, and in the movie they say that baseball was broken because they were investing in players when what they should have been investing is runs. And that's kind of the way we view what we do here. We're not investing in companies as much as we're looking to invest in free cash flow. That's what we do. We're just looking for ways to find free cash flow to invest your money. And more free cash flow down the road generally fares better for stock prices. So, hype and headlines and everything else, and that doesn't matter. We're just looking to score runs here and get some free cash flow. And so this chart here, which I'm going to come back to, this is price to free cash flow right now. And so I'm going to highlight the two cheapest places where you can buy free cash flow right now, where you can invest money, is in utilities at about $12 per dollar of cash flow, and energy. So this is the cheapest places to get price to free cash flow generation. Information technology is higher. Now, why would you pay a higher price for free cash flow? It's because you're paying for the future free cash flow that could be much higher down the road. You're paying for the growth. You're paying for the potential. And so what we do is we make both investments. We look for stable investments and free cash flow today, and we look for investments where we get the potential for strong growth down the road. And so that's why, you can see things like energy and utilities in your portfolio. Now we're going to talk a little bit about technology and kind of some of the, investment themes that have been happening. First, data center blockages. So this has been a risk. We've had our kind of list of different risks that could be hitting the data center build out, because it's been the most incredible CapEx cycle of our lifetime. And one of the issues is potential blockages, moratoriums from states, things of that nature. I thought this was a really interesting chart, so I just wanted to share it. One of the reasons why they say they're blocking data centers is because they have an impact on energy prices. Two of the strongest states for data center growth are Texas and Virginia. They are right here. So this is load growth on the horizontal axis. Their growth in the usage of their infrastructure, and then the price change per kilowatt hour on this axis. As you can see, Texas and Virginia, who've been seeing a lot of growth in a load in the data centers, haven't had a lot of pressure on their pricing. And actually, Texas is an incredible example of a state that has really deployed a lot of renewables, which is, surprising to me, but they've done a really great job of deploying renewables. Whereas you have, a state with decreasing load growth, but the highest price growth, like California, and New York is also in that basket. So there's, the reality is probably going to win out here, is that the data centers aren't really putting a lot of pressure on the grid. And actually, people did some really good, looking back at things that are putting pressure on the grid. Steel production does way more on the energy grid than data centers. The next theme is the cost to actually deploy AI. This is a big one. This is a huge one, and it's putting a lot of scare in the market around this build out. Because that's the thing with markets, is when you build in big expectations, you get a lot of, potential for people to get afraid and try to pull back and pull their money out. Another chart that I thought was really fascinating. This is among the top 1% of firms in the US in terms of their AI usage, their AI adoption. And this is what they're finding. This is their spend on AI per employee. And it's approaching the average US worker cost per year and trending higher. And so one of our most recent weekly market commentaries, we wrote about how a survey of CIOs found that their 2026 budget for AI spend, the entire year, they blew through it in Q1. The hyperscalers who are delivering the AI, who are processing the tokens, they are moving away from these all-you-can-eat models where you can just consume as much AI as you want, to a buy token model. So you're actually going to pay for your usage. The reason why is because it's been surprising. The usage has been high. People have been utilizing it a lot more, and the costs are ramping up. And so this is going to be a big theme for AI for the rest of the year. The next thing, and you might have read about this last week, but last Thursday was the big reveal of Kimi K3, a low-cost Chinese AI model. And so you've got companies like Anthropic and OpenAI who come out with what they call these frontier models. And so these are the best of the best models, and they're relatively expensive. So Moonshot is an AI company out of China, and they released their Kimi K3 model last week, and the cost per token is estimated at about 1/100th of the frontier models from OpenAI and Anthropic. And it can theoretically be an open model, which means that it doesn't even have to necessarily run off of the Moonshot servers. And so this has put some fear in the market. And immediately on Thursday, when it came out, if you remember the DeepSeek scare last year. So last year in 2025, early in the year, NVIDIA dropped by 17% in one day. It was the biggest market cap decline in history of any company when a Chinese company released their DeepSeek model. And the claim was that they're able to train this AI model using a fraction of the GPUs that it normally takes. And so that led the market to think, okay, it turns out you don't need all these, tens of billions of dollars of NVIDIA GPUs to create these things. It caused the market to plummet. And now what's happening is people are saying, okay, this Kimi thing, well, the reality of DeepSeek was that they're like, well, they figured out it actually did take quite a few GPUs. They were just, getting them into China through Vietnam and other avenues. And so when this model came out, the accusation, people were like, oh, don't worry about this Kimi V3 model because it's actually based on Anthropic's Claude. It's just stolen code. And so one of the individuals who was writing about it said that if you do an open router and you set open router settings and you communicate with Kimi, it'll actually admit that it's Anthropic's Claude. So we did that. So we here on Friday morning, we opened up an open server. We wrote Python code. We going through OpenAI's backends. We communicated directly with the Kimi server, and we did that away from isolated from a different system, isolated from any client information. It wasn't anywhere near anything that was sensitive. We communicated with it directly using the API key. We asked it questions. We said, hey, are you related to Claude? No, not Claude, not built on Anthropic models. We kept asking questions, and so not necessarily debunking what people were saying, but from now it looks like it's the real deal, and that China is producing low-cost AI models. And so, what is this a threat towards? It seems like it's largely a threat of OpenAI and Anthropic, and not necessarily as big of a threat towards the hyperscalers, and possibly even an opportunity for them. But here's the thing with hyperscalers that has everyone worried. And it's that hyperscalers were financing a lot of their CapEx using cash, and they're running out of cash. And so now what they're doing is they're looking to take on debts. They're taking on debt through BDCs. They're taking on, they're getting private credits, and then they're issuing loans. And so what's happening is we're seeing the highest rates of bond spreads for the hyperscalers in over a decade. And so the market's getting a bit concerned about the amount of debt that the hyperscalers are taking on, and it's going to continue to be part of the narrative going forward. And so this is an area that we continue to be watching closely in the earnings calls in the next 2 weeks. We're going to be listening to all of them and looking at their financials and seeing how much is the debt load going up, how much risk is being assumed here to build out this CapEx, and we will be adjusting our allocations accordingly to just to avoid parts of the market which could be taking on too much debt risk. And then we're going to kind of wrap it up here with kind of highlighting a little like a Venn diagram of our basket of trade approaches. And so at the top here, we've got global conflicts, and we've got our overweight energy, which captures some of that. We've got our overweight industrials, which has a lot of exposure to defense and aerospace and things like that, which that kind of ties into the global conflict theme. And then if we go to the left, supply bottlenecks, energy prices up because of supply bottlenecks in the Strait of Hormuz. We have our exposure there. We also have our data center hardware exposure. The memory producers, the semiconductor producers are still supply constraints. And so that is part of that theme that we're playing in right there as well. Security and intellectual property, data center hardware. Sovereign nations around the world are going to continue to look to buy GPUs and memory from U.S. producers. so they can build out their own stacks and do their own localized AI so they don't have to rely on international models threatening their IP and data security. And on the other side of this, we've got the hyperscalers. The hyperscalers can continue to deliver security and IP with open models, but in a more secure manner to businesses that are becoming more and more concerned about companies like Anthropic and OpenAI stealing their business models as they work with them. And then back over on this side, capital improvements from AI. We're capturing that, like I said, with industrials. Industrials have seen continued tailwinds from the data center build out in other areas. And then on the bottom side, biotech. Biotech has seen a bit of a resurgence in the last 6 to 9 months. The projection of drug discovery is ramping up quick. This is one area that AI is going to help feed into a lot. The process of drug discovery is arduous. It is procedural. It is looking through endless data points, and AI is rapidly moving this forward. And at the bottom is just rotation. So hyperscalers saw a bit of a sell-off. Money has flown into other parts. Looks like money could flow back in the hyperscalers. And then biotech healthcare has been part of that rotation as well. So as places rotate out, they can rotate into those. So these are kind of 5 themes that we've been thinking about, we've been allocating to. In rotation, we can also write small caps, small companies. And so these have been the basket trade approaches that we've been using. And then we'll probably swap 1 or 2 of these out throughout the rest of the year. So at the end of the year, 2 or 3 of these could remain. We could see 1 or 2 new ones. Next, we're going to talk briefly about emerging markets. So South America, Asia, a few other places around the country, around the world that are have the potential to grow really rapidly. One of the things about the emerging markets that has been incredible is the concentration. So we think we have concentration in the S&P 500. The MSCI Emerging Markets Index is over, it was recently, there's been a little bit of a sell-off, but as of recently, 3 companies accounted for more than 30% of the entire index. If you look at the Kospi, this is South Korea, 2 companies, 50% of an entire country's index. And then like the third company, which I think was Hyundai Capital, was like 3%. It was just massive concentration of 2 companies. And so it brings about the potential for risk. And so we're being very measured in our emerging markets exposure and where and how we do that. Now we're going to talk a little bit about bonds, and we've kind of had a similar approach for the past couple of years. But on the left here, we're going to talk about credit risk. So with bonds, you can take on more credit risk, and you should theoretically be paid more for taking on more credit risk, but it exposes you to more risk. And so on the left here, this is the credit spread. So this is the amount of extra return you get on taking on high yield bonds. And as you can see, it's low, and it's been low. And there was a time this year where it spiked up. We were just getting interested right about there, and it came back down. And then on the right here, what you see is this is the excess return for high yield. So on the left hand here, this is the amount of excess return you get. And then down here, this is the spread. So when the spread gets wider, right, when it gets kind of up here, that's where you see more excess return on high yield. When spreads are tight, which right now we're like right here, you get less excess return. It's clustered more in the negative area. So this is one of the primary drivers why we're just not interested in taking on a lot of bond risk. But if it gets back up into this higher area again, I mean, you'll believe that. You'll see it. We'll move more into high yield bonds, and we'll take that opportunity. But right now, corporate bonds, while we're at record high corporate profit margins, cash balances are still high. Yields are over 5%. So that's a healthy bond yield. That's a good place to be. Get 5% plus in your bonds. If your stocks have a major sell-off, they could still be a strong ballast for you, give you some good income return. And then lastly, this is just kind of an interesting look at where the 10-year Treasury has been. We had kind of generated a heuristic last year, which was, let's sell when the 10-year yield drops below 4%. And so last year that happened right there on one day. One day, the 10-year yield went below 10% or went below 4%, and we sold over 2.3 million of long-term corporate bonds. And we had a very small opportunity to do that again this year. One day last year, one day this year, where we're able to sell duration below 4% on a
Yeah,
10-year
before you
basis.
move on from that, John, I just want
Mhm.
to comment and say this is the advantage of us looking at your portfolios every single day, understanding the market and being able to move very quickly because the market changes very quickly. And the importance is that John and I had already made this decision before it happened so that we knew when it was going to happen, when it did happen, we would make a move. So this is the kind of management that we do, which benefits all of you with your portfolios. Go ahead, John.
Thank you, Larry. So we'll do a little wrap up and conclusion, but there has been a pronounced multiple contraction amongst large cap names, and the market is rightfully so worried about the durability of earnings generated from the data center build out. We're watching it extremely closely. We only dedicate 3 or 4 slides of this presentation to bonds, and that's because bonds aren't as volatile. We're hyper focused on the more volatile areas of the market, the areas that can have much more impactful outcomes on the portfolio. And so an earnings miss or lower guidance will surely exacerbate any kind of multiple contraction. So we're looking for companies with resilient earnings. We're looking for less speculation. However, like we mentioned towards the beginning of the presentation, we're getting a little more comfortable with where things are. Multiples have come down. There's still good earnings growth potential, and so so there's a little less risk there. But we're still going to be very choosy where we're allocating. Small and mid-sized companies, they still look relatively cheap, and the current 12-month outlook of the economic cycle looks stable. So the thing about the small and mid-sized companies is that they can be good growers, but if the economy takes a turn for the worse, they're usually the most severely impacted. And so that's one of the areas you got to look is, how's the economy doing if you're going to look to increase your allocation to small and mid-sized companies. We do think the market's overestimated the Fed's willingness to reverse course and hike rates. The Fed could surprise us. It's a new Fed chair. He's very different in that he really does not like to communicate with the markets. Historically, the Fed has been really big on, being very concise and clear about setting expectations. And if you look at the Fed commentary prior to this chair, and then the most recent one they published, he cut out like half the language. And so, there could be a surprise there, but if we think about the mechanisms and why inflation or why you'd hike rates and the trend we've been on and how much sensitivity there is in the market. I mean, you've got the bottom quartile of earners that are struggling with debts and credit cards and things. It doesn't make a lot of sense to us. And then lastly, we think there's great opportunities in emerging markets. However, we're going to be more selective in our investments. This is one area that we're looking. We're looking in emerging markets to make some more investments. But there are substantial risks there, so it's not going to be on a broad-based index basis is how we're looking. But this is kind of where we're looking for the rest of the year. And at the end of the year, we'll give another presentation to kind of wrap this up and then also give a good projection for 2027. So I'm just going to cycle through a few disclosures here, but that is everything.
Yeah, so we are recording this. We are going to send it out in our weekly market commentary once it goes to compliance. That way people can listen to it. This is a great way for people to get to know us and what it is that we do. If there's anybody that that needs this kind of wealth management and care for their portfolios, please pass it along to them and let them know about us and what it is that we do here at WealthWise. We very much appreciate all of you on the call, taking the time to listen to what we have to say. And of course, we want to meet with all of you individually as well for your own individual needs. And as I look at the names on here on the call, thank you to all of you. Some of you I've talked to very recently, even today, and some of you it's been a moment. So as always, we want to meet your needs and go over things. And we set up a strategy session to go over your own portfolio as well as your financial planning, make sure that you're on track. with your goals and what it is that you're looking to do for you and your family. As I think about the second half of the year, apart from just, what we've been talking about market-wise, the second half of the year is really all about looking at your taxes, making sure that we're in line with everything as far as expectations before year end. What is it that you can really do between now and the end of the year to mitigate taxes, to really think through your planning? And so, of course, and then what we do is we always do tax loss harvesting during the year, but then also especially looking at the end of the year, what can we do on your behalf there? With that, John, anything else that you can think of before we close it out?
I really appreciate everyone joining the call today. I really appreciate every chance I get to interact with all of you, and just really appreciate it.
Absolutely. And so every Monday, like John said, the weekly market commentary is individually curated by our office. So it's not something we subscribe to and we're just pushing it out. In addition to ours that we put in there, the first thing is our own weekly market commentary. And then there's some other things in there as well. But please look at that because you're getting our best thoughts on exactly what's happening right now in the market. So be sure to look at that. With that, please contact us one-on-one. We'll be happy to discuss things with you. And thank you for joining us. Thank you, and talk to you soon.
Thank you.